Hey everybody, Cody here again with Sound Planning Group, here to talk about retirement. Now, as you may or actually may not know, the One Big Beautiful Bill Act passed last month, and there is a whole lot of stuff in it. And most of it we're not going to talk at all about today because we talk about retirement here. But what we are going to talk about is the three critical changes that happened due to the bill as they relate to retirement. And I'm going to show you a little bit of a case study and really the impact on income in retirement as a result of this act passing. And so the crazy thing is, if you looked, and if I asked you a quiz question on what do you think the highest tax rates in history have been, you might say 60%, you might say 50, you might say 80, and then you'd be wrong if you said all three of those. The highest tax rate in this country's history was actually in World War II. It was 94%. Now, obviously, there were a lot of things going on in World War II and a lot of things to pay for, but the reality is you needed more than $8 million gross to net $1 million. Thank God we're not in that time period. But interestingly enough, the average tax rate in history, or in American history, has been about 55%. And it's easy to forget that right now we are in the lowest tax rates that we've ever seen in American history. Now, what I'm going to talk about first is what was going to happen if this One Big Beautiful Bill, I'm going to call it the OBBB, would not have passed. And first and foremost, where I think you should know the most about it is how it would have impacted your actual tax rates. You see, at the end of this year, had that not have been passed, the Pre-Tax Cuts and Jobs Act, which is the bill that was passed in 2017 that created the tax rates as we see them today, well, those would have sunsetted, and the tax rates before the Tax Cuts and Jobs Act actually would have been enacted, or they would have been in effect starting in 2026. So what I want to do is kind of share with you, where we're at today, where they would have been, the difference between those two, and why it's actually such a big deal for your retirement. What I'm going to do after that is show you a real life example of someone retiring in 2026 with almost 100 grand in income and what their taxable income will be, and how some of these provisions just make it so significant in a good way, in a positive way for most American retirees today. So we're going to go to my screen real quick and I'm going to explain to you exactly what this looks like. So what you'll see here is the first box is the Pre-Tax Cuts and Jobs Act marginal tax rates, and the box on the right is the tax rates as they are today in 2025. So you'll see here the biggest difference was that the 2017 Tax Cuts and Jobs Act, which are now permanent, essentially they reduced the tax rates, which were 10, 15, 25, 28, 33, 35, 39.6, and then made them 10, 12, 22, 24, 32, 35, and 37. So you can see these are pretty marked differences in the way that the marginal tax rates actually function. Now, again, the OBBB actually made these permanent. Now, I want to point out this 24% bracket here, because you'll see that if you have income from $206,000 to $394,000, you actually stay in the 24% bracket. Now, again, had this bill not have passed, these rates would have actually reverted to the Pre-Tax Cuts and Jobs Act marginal rate. Now, that means that from 150 to 237, you'd actually be in the 28% bracket. So let's say, someone with 225,000. And at first glimpse, you might say, well, Cody, come on. How much of a difference really is 24 to 28%? So what? I'm actually paying 4% more in taxes. But that's not really how math works. In fact, if we take, 4 as a number of 24, it's actually 16%. So your taxes would not have gone up 4%. Your taxes would actually have gone up 16%. I'm not a big fan of paying more than I owe. I want to pay my fair share and I want to fund and invest in our country, but I don't want to pay or overpay the Treasury any more than I have to. And if you're listening to this video, you probably don't either. So number one, this is the, most significant, or one of the most significant provisions of the OBBB. The tax rates on your right are now locked in. There's some inflation provisions to them. So that means that 206 to 394 is actually going to continue to go up. Now, the second part of what we're going to talk about, and by far I think is going to impact the most amount of Americans the most amount of Americans on top of what we just went through, is the fact that there's now going to be an additional standard deduction. So everybody was hoping that the, taxes on Social Security would be null and void. No more taxes on Social Security. The reality is that was just way too hard to pass, right? And so they couldn't quite get that done, but they did compromise, which is shocking in today's political landscape. But what I'm going to do next is show you what that compromise looks like and what the new standard deduction provisions actually are. So let's go back to the screen. We'll flip the slide. So the enhanced standard deduction is here to stay. The beginning in 2025, the deduction is $31,500 for married couples filing jointly, $15,750 for single filers. It's important to note that the tax cuts or the marginal rates I showed you on the previous page were for married filing joint couples. But here is the big one, the new senior income deduction that was introduced. Again, this is kind of the compromise because they couldn't get no taxes on Social Security. But if you are 65 years and older, you will get a new deduction of $6,000 off of your tax or on your tax bill. And if you are married, it's actually times 2. So you get $12,000 on top of the $31,500. Now, it's important also to understand that that will phase out, meaning if you're a married couple, once you hit $150,000, that starts to decrease. And if you hit $250,000 as a married couple, you completely lose that $12,000 bonus deduction. But the multitude of American families that are 65 and above are going to actually get that senior deduction. And I wanted to do just a little bit of a case study here, assuming someone retiring at 2026. So again, married couple, age 65, is going to have $46,500 as a standard deduction. That means just for the benefit of being an American citizen, the first $46,500 is on the federal government. Thank you. That's awesome. Now, let's look at someone who actually was going to retire in 2026 and take a look at a couple of income sources here. So this is George and Martha Washington. You'll see that in 2026, they need about $95,000. And here's how they're going to get that. So between Martha and George, the Social Security benefits are going to be about $5,100 a month, or a total of $61,548. And then they're going to supplement a little bit with their traditional IRA withdrawals at $33,000. They're going to have a little bit of bank interest as well. And so between these two sources, it's going to be about $95,275. Let's take a look at a quick tax return. I'm going to make this simple and easy for you so you can actually get a feel for what it's going to mean for them and for millions of Americans in retirement that are 65 or older. So here's a, quick and dirty tax return, not working anymore, no qualified contributions to IRAs or 401ks. Taxable Social Security, $25,281. Remember on this previous screen, they had $61,548 of Social Security. I'll stop right here and tell you that it's important. One thing to understand is that, remember, if you have only Social Security benefits coming in as a family, you pay absolutely no taxes. Social Security in and of itself is not taxable. It's only once other withdrawals from, say, pension, IRA, municipal bond interest, yes, tax-free interest does go on the provisional income calculation for Social Security, but it's only once those other income sources are included onto Social Security benefits that Social Security starts to become taxable. The nice thing is that even if you have, $500,000 or $1 million in income, Social Security will only ever be 85% taxable, meaning only 85% of your benefits will ever get included onto your tax return. So that's an important component. Now back to the screen here. What you'll see here is the $95,275. Again, $61,000 in income, $33,000 in withdrawals, $95,000 total. But $25,281 is their taxable Social Security. Cody, how could it be that I have $61,000 of Social Security benefits, but only $25,000 of it is taxable? Just like I explained, because of the provisional income calculation and because they only have $33,000 in IRA withdrawals, not all of their Social Security is going to be taxable. That's a win. Remember, I said they did have $1,500 in 1099 interest, and then the $34,360 makes up the taxable withdrawals or the traditional IRA withdrawals. their gross income is going to be $61,190. However, their taxable income is only $14,490. Look at that difference. You have their total gross income of $95,000 or $96,000, but because only a little bit of Social Security is taxable, their gross income for federal tax purposes is only $61,190, but their taxable income is $14,490. Why is that? Well, here's where this new senior deduction really comes in. So again, married couple, the standard deduction, $31,500, but here it is. Client 65 plus gets $1,600. Spouse 65 plus gets $1,600. So this is just actually for the benefit of being 65. They get these additional standard deductions. For someone that's blind, they also get another one. George and Martha are not blind. And then here is the senior bonus deduction, $6,000 each, making the total standard deduction $46,700. How does it impact the bottom line? Well, as we talked about a second ago, now with the 2025 Tax Cuts and Jobs Act permanent marginal rates, in 2026, the 10% bracket means that from 0 to $23,850 in taxable income, George and Martha are in the 10% marginal rate, which means if their gross income is $14,490 and they're in the 10% rate, their tax bill's a whopping $1,449. But if we take that a step even further, on $96,284 of total income, their effective rate, meaning what their actual rate is when you look at the total income that they get versus the taxes they pay, the effective rate is only 1.5%. Now, if you go to the average person on the street and say, you know what, I'm 65, my total income is $100,000. What percentage am I paying on all of those dollars in taxes? You'll probably get answers like 10, 15, 20%. The real answer in this case is 1.5%. So guys, those three things that I just talked about, the Tax Cuts and Jobs Act, marginal rates becoming permanent, the standard deduction staying, the enhanced standard deduction staying, and then the senior standard deduction, the bonus deduction is what they call it, which is only lasting for another 4 years, but still, we'll take it, right? That means an additional $12,000 if you're married, 65 and over. If you make, up to $150,000 of joint income and it completely phases out at $250,000, regardless, for the mass amount of Americans who are retiring in this country and the wave of baby boomers, there are many that will actually feel that impact. It will really help their bottom line. They'll take home more money. That means they'll get to spend more of it in the economy and do more things with that cash that they get in their hands. So guys, I hope that helped. If you want to go look at all the other things that happened with the OBBBA, you can. There's a bunch of stuff online, but I really wanted to educate you when it comes to, what's actually happening in retirement and why it's going to actually matter to you. So I hope this helped. Again, in the link, you can hit, in the description below, you can hit the link, go to myspg.com if you'd like help seeing how this affects your actual tax return and your long-term retirement glide path. We'd be happy to help. Have an amazing day, and we will see you on the other videos.